Good morning. Today, February 17th, 2026, the Magnificent Seven have officially hit the reality wall. While the broader S&P 500 remains surprisingly resilient, we are witnessing a violent decoupling within the megacap tech cohort. On one side, we have the merchant king, Nvidia. Despite a 2.2% slip in today's session, it remains the only primary beneficiary of the current infrastructure cycle, capturing capital as immediate revenue. On the other side, we have the hyperscale casualty list. This morning, Microsoft and Amazon officially entered bear market territory, down 27% and 23% from their respective 52-week peaks. This isn't an earnings miss, it's a valuation reset. The market is no longer rewarding vision, it is punishing the cost of admission. The numbers we are tracking today are unprecedented in the history of capital markets. The collective 2026 capital expenditure guidance for the Mag 7 has now reached a staggering midpoint of $680 billion to $700 billion. Let's look at the biggest checkbooks. Amazon is leading the charge with a $200 billion mandate, a 53% year-over-year increase that analysts at Morgan Stanley warn could turn the company's storied free cash flow negative this fiscal year. Alphabet has doubled its spend to $180 billion. Fueling a fourfold increase in long-term debt to $46.5 billion. The technical term for what we're seeing is FCF compression. We are tracking a monetization gap where the upfront cost of data centers and custom silicon, like Alphabet's TPU and Amazon's Trainium, is outstripping near-term Azure and AWS growth rates. 1.3. Microsoft's 38% Azure growth is great by historical standards, but against a $144 billion annualized CapEx run rate, the street was looking for 40+. Institutional sentiment is shifting toward what we call the halo trade: hard assets, logistics, and operations. Morgan Stanley's Mike Wilson notes that the market is rotating into the physical backbone of AI, but the 5-year outlook remains dominated by the agentic shift. By the spring of this year, we expect agentic AI models to achieve human-level reasoning. This is why the $700 billion spend exists. These companies are not just buying chips, they are building a global digital labor force. This is the thesis behind Bill Ackman's new $2 billion stake in Meta Platforms. Despite Meta's high capex, which Barclays warns could drop its 2026 free cash flow to zero, Ackman is betting on the deep value of a business trading at 22 times forward earnings, while its AI-powered ad engine, Lattice, drives 30% revenue growth. The next 60 months will define which of these giants becomes a permanent AI utility and which becomes a capital-intensive money pit. For daily institutional-grade analysis on the technical breakdowns and fiscal pivots of the Mag 7, hit the subscribe button and turn on notifications. We track the data so you can track the alpha, and we'll see you at the opening bell.